whenever I speak to either an institutional guy or a retail guy, I ask them what they look for in whether it's a broker or a dealer or a platform, and a lot of them say, "Oh, I like a tight bid offer spread, right? Or I like really good technical analysis, or I like really good execution tools." And I say to them, "Aren't you worried about getting your money back?"
So welcome back today. We're sitting down with Steve Miley. Steve, welcome back on the podcast. We spoke a few months ago about your path as an institutional trader. You worked for big firms in the past. Today I want to kind of focus on prop firms, what's going on with prop firms these days and how to adapt. So welcome back on the podcast. Good to have you here again.
Yeah, good to be on, Etienne. Great to be back on. I thought we went really well last time. I really enjoyed it, actually. So, happy to be back on and talk about, current state of the industry and what's going on for people in the prop trading world, from our side, and then also from the user side, and any kind of advice and tips and tricks we can give. Well, not tricks really, but to any of the traders out there. Yeah, more than happy to share that.
Definitely. So let me kind of start with this first. Where do you think prop firms are heading? Are they heading to a point where it's going to be hard to have any prop firms left, or is it going to be better for the trader? Or what do you think that's going over the next few months or years?
I think the opposite really. I think I haven't actually watched this interview yet, but someone shared an interview with I think it was the CEO of Oanda, the broker. And they were basically saying they see, even as a broker, that as prop firms as the future, and they could end up either cannibalizing the brokers themselves, or the brokers obviously could come in and buy prop firms, or the brokers could shift and have prop firm arms, kind of stuff. So, and it could be all of a combination of those. I can easily see that, and speaking to some of the other senior members of prop firm companies on the future side anyway, a lot of them do see that as a potential way for the prop firm industry and the broking industry to go, for there to be more of a coming together, and that could be through mergers and acquisitions, takeovers. It could be just opening up new arms or whatever it might be. So if anything, I see this as and with that process, there's always bumps, right? And that's what the market's going through at the moment. That's what the industry's going through. And there's a finding its way on the regulatory side. And until we have some kind of better understanding, from my perspective, and clearly, being the owner of a futures prop trading firm, I see the futures side of the business as more secure. And I think it always has been more secure than what we call Forex, but you and I know it's not really Forex, it's CFD trading. That's what it is. It's CFD. And I think there's some, and we can talk about that if you want. I'm more than happy to go into the different definitions of what these different markets are, because I think people just call it Forex because that's how it started, as mostly trading foreign exchange markets, but it isn't really Forex, it's CFD trading, and Forex is one of the asset classes within CFD trading. So, but yeah, I see the future side as very much more secure for me, for obvious reasons, in that you have an exchange and the data is real data from the exchange that the institutional market is trading, where on the Forex/CFD side it's not, and that data is from a pool of data. There's some blurred lines between whether you're dealing with a broker or a dealer, or a combination of broker-dealer, which you don't have on the futures side. So for me, I think this is healthy in the long run, the challenges that are being faced. In the early days of the CFD world, the same kind of issues were faced of, these speed bumps and getting over regulatory hurdles. And we kind of welcome that on the future side. I can't speak for how the CFD side of the prop trading world looks at it, because obviously they're being impacted more significantly and more negatively in a lot of ways. But from the future side, we kind of welcome and are very confident in our positioning from a regulatory standpoint.
A lot of brokers have been coming up with their own prop firms now, or at least kind of a way to get funding accounts with them.
Yeah.
What do you think that's going to lead the individual prop firms? Is it going to be harder to compete, or is it going to be kind of like you still have a good advantage with these broker having prop firms.
From my side, I think that it will be. It's going to make challenges, right? It's going to be challenges for all prop firms, and it's how we tread the path going forward, and it's whether we have closer ties up with brokers, on the future side, certainly, we have close ties to the brokers that we are involved with, and with our US clearing companies on the futures side. So I do see that coming together. I don't see it as necessarily a big issue. I think maybe on the CFD side there is more of an issue, and it's something that I don't think we find as much of a challenge on the future side. I think on the CFD side, if I was a CFD prop firm, I would probably be a little concerned that CFD/Forex brokers are going to start up their own prop trading arms, as a sideline. And then they have huge databases. Obviously, they have huge amount of clients, and they could easily entice their clients. And then they'll have two income streams, separate income streams. So, on the CFD side, I think it could be trickier for those CFD prop firms. But you kind of have to remember some of the CFD prop firms, the larger ones are as not maybe quite as big as, but close to being as big as some of the larger brokers as well, so, and they're certainly larger than a lot of the mid-tier and lower tier CFD brokers out there. So I guess if I was one of the largest CFD prop firms, I'd be happy to bring it on and take on the competition, and they could even be in a position that they could go and buy their own brokers, right, and merge with brokers. But again, that brings its own regulatory challenges as well. So, and again, that's not the space we're in. On the futures side, I think there will be some further coming together, but I think it will be more of a, we already have those relationships with the brokers on the futures side. For example, we have a relationship. I'm just going to pick Trader8/Ninja Trader, right? But and we have a relationship there. But the other prop firms in the future space also have their relationships wherever that might be. And so I think healthy competition is very much that. It's healthy, and I think particularly at trade day, we're pretty well positioned in where we are in the market. We are not the cheapest company in the market for our evaluations, but we bring a lot of extra to the table. We feel we're very competitive on our end of day drawdowns. We have very competitive profit to TMD ratios. We have a very flexible, probably the most flexible withdrawal policy in the industry, and we produce a huge amount of research, of educational content, and support for our traders. So we feel like we are trying to actually replicate what is more like the professional prop trading group is giving to its prop traders within within the retail realm.
Maybe you can give us a quick intro to like CFDs versus Forex that you talked about before. So people think they trade Forex, they trade CFD instead. What kind of issue can that cause, and what do you see that doesn't work about this?
Yeah, well, I don't think, I think it's more the fact that when you're trading Forex, when people say trade Forex, right? They're trading a CFD. That's what they're trading. They're trading a CFD, a contract for difference, and you are trading with, you're signed up with a broker, and that broker is offering you, and people say Forex, right? But it's really a CFD. Forex is an asset class. It's not a type of trading, it's not a type of prop company. It's an asset class, and which is foreign exchange. So you're trading currencies. And the only way for retail traders to really trade currencies, a bank will literally trade euro versus dollar by transferring euros versus dollars. Yeah, it's a physical exchange of euros versus dollars. But as a individual, you're not going to buy and sell hundreds of thousands of euros versus hundreds of thousands of dollars. And so you have a CFD, which is a contract for difference. So you buy it at one level and you sell it at another level, and if it's a positive outcome, then you make a profit on that difference between the two prices. And so I think a lot of people think they're trading Forex, and they are trading Forex as such, but really it's a contract for difference. It's a CFD, and it's on a Forex, on a currency market. And so obviously then you can have CFDs as well any market that's pretty much out there now. So you can trade the S&P, you can trade the NASDAQ, you can trade government bonds, European government bonds, US government bonds, Japanese government bonds. You can trade oil, gold, you can trade copper, you can trade hogs, you can trade all sorts of things, right? There's a wealth of pretty much any asset class out there now. There is a CFD on it, right? And so you're not buying or selling the actual underlying asset itself. You're just having a view on whether that asset is going up, and it's done on the CFD with a CFD, a contract for difference. And so your account then is effectively with the broker. Now, whether the broker acts as broker and dealer, but that liquidity pool that they're tapping into, the broker, they can either offset your trade or not, and that's kind of to an extent their choice. And there's been the whole issue previously around the A book and the B book, whether the CFD broker are offloading your position or whether they're actually going against you in the trade, right? So there are issues around that, and that's what a lot of the issues that came up for prop firms from the CFD side. That's the case that came last year from the CFTC, because it was selling into the US. That was the issue. That was one of the issues anyway. So I think a lot of people think they're trading Forex, in quotes, Forex, but what they're really trading is a CFD on the currency market. And you can trade a CFD on all those other asset classes as well. Futures, really what CFDs are just futures contracts for the retail broker, for the retail trader, provided by the retail brokers. The futures markets are institutional. They've been around. Futures markets actually have been around for hundreds and hundreds of years. The candlestick formations come from a trader from the rice futures markets from Osaka in Japan. So that's the founder of candlestick formations, was a very successful multi-billionaire of his time on the rice markets out of Japan. So futures markets have been around a long time, but they've been usually very much institutional. And then the current futures markets really had their rebirth out of Chicago, and they are aimed at institutional traders. But there has been a movement towards with mini and micro contracts to allow them to be more accessible to retail traders. But the critical thing on the futures side, which Trade Day is in the futures prop space compared to CFD, is that the market is being made. It's the institutional market. It's the real market offered on exchange. So, for example, if you're trading S&P futures, you're likely trading them on the CME, the Chicago Mercantile Exchange, and that data is the same data that is coming from the exchange that Fidelity are trading, that BlackRock are trading, that Goldman Sachs are trading. It's the same bid offer, and there's no difference. So there's no ability for the broker or the prop firm to change that data and manipulate that data. And that was one of the other accusations from the CFTC against the prop trading firm from last year. I don't really want to start naming names, but we know what prop trading firm it was from the CFD side, and that they were acting as broker and dealer, right? They were acting as broker and dealer, and because they weren't offlaying, they were the market as well, and they were to an extent, according to the CFTC, not according to me, manipulating that market and manipulating the bid offer spread, which is impossible to do if you're on the future side, because all the data is coming from an exchange, which is an exchange that's covered by the CFTC. So that's the futures regulator in the US, who then oversee the exchanges. So it's all very, very, very transparent. So I hope that it's cleared that up a little bit. I mean, it sounds more complicated than it is, but basically Forex and CFD are the same thing. And the main difference between Forex, CFD and futures is futures originally more institutional, but is actually the data comes from a real exchange, which we don't get on the CFD side, because that data is coming from a pool of data that is not necessarily regulated. It kind of echoes what the real market is, but it's not necessarily exactly the same as what the real market is.
Do you think futures is a good fit for everyone who's trading, let's say, CFDs? Could they all move to futures and be all right? Or are there some people who wouldn't be able to move to futures and trade futures?
Yeah, it's a good question. I mean, we've actually just released, we've released some ebooks on this, on both Forex and on the CFD side, and you can find those, or you can contact us at Trade Day. We can let you have those, any of your viewers. But I think the main attraction these days is that it's safer, because of the regulatory side. That's the main attraction. The main, I think, concern for anyone looking to move across from maybe the CFD Forex world into the futures side is that it feels a little bit more complicated, right? Because we do have, for example, futures expiry, which you may not have to deal with. The contracts roll off typically every 3 months, but in some cases once a month. And that kind of can be a little bit confusing. But ultimately, from a trader's perspective, I've mentored on the retail side for way over a decade now, and I've been in financial markets for 30 years, on the 20 plus years on the institutional side. And whenever I speak to either an institutional guy or a retail guy, I ask them what they look for in whether it's a broker or a dealer or a platform. And a lot of them say, oh, I like a tight bid offer spread, right? Or I like really good technical analysis, or I like really good execution tools. And I say to them, aren't you worried about getting your money back? And that's the most important thing, right? The most important thing is to know your money is secure. And I think that's one of the attractions of coming along to the future side, because there is this question mark because of recent events on the CFD side. I mean, a great example of this, right? A great example of particularly way the A book and B book works, right? And I'm not saying this didn't impact on the institutional side. And I'm showing my age a bit now because I'm going, but Etienne, you might remember this. So this was about 10 years ago. There was a floor put by the Swiss National Bank on the euro versus the Swiss franc at 120. And that stayed there for, I'm going to say, over a year. Actually, it's more than 10 years. I was at Credit Suisse, so it was probably 15 years ago. And overnight, the Swiss National Bank pulled the floor. So they basically put in a ceiling on the strength of the Swiss franc, and they pulled that floor. So, and what happened then, immediately, euro versus Swiss franc plunged lower. I mean, immediately, by I think something like 25-30% immediately. It just plunged lower in a matter of seconds, which was completely unexpected, because this basically the Swiss National Bank were sitting there and not allowing euro versus Swiss franc to go below 120. They were sitting on the bid there in a matter of hundreds of millions of euros versus Swiss francs. So they weren't allowing it to go down. And then they pulled that. And one of the consequences of that was one of the probably biggest brokers in the world at the time, retail brokers, was Alpari. And Alpari, I'm a West Ham fan. I support West Ham Football Club. And Alpari were the shirt sponsor for West Ham at the time. They weren't within a day, because Alpari effectively went under that day. And that's because, one of the biggest brokers retail brokers in the world wasn't fully hedged, against the risk of that happening. So they weren't acting purely as broker. There was part of it, they were acting as broker dealer. So they weren't fully hedged on what their client's exposure was, which meant that when it dropped, they were in the hole for, I don't know the numbers off the top of my head, but I'm going to say it's in the hundreds of millions of dollars. And they disappeared, and they will end up being bought out. And I still think the company survives under the name, but, effectively the company was bankrupt immediately. And so that's the kind of risk that you don't see on the futures side. It's a long story to get to that, but because the exchange is always sat in the middle. When you're trading futures, you're not trading with another counterparty, you're trading with the exchange effectively. So the exchange is the counterparty to every single transaction. They're the buyer to every seller, and they are the seller to every buyer. So they effectively act as a buffer to any kind of losses like that. So you're not actually got any risk, counterparty risk. So that removes the counterparty risk. So going back to your question, which I'm sort of trying to get to, is are there any hurdles, and what would stop someone coming across? Well, that's clearly one of the reasons why you probably would come across. One of the hurdles is the I think people struggle with maybe the rollover, but that's not too complex once you get your head around it and you kind of understand that. There is also, because of the security which I've just outlined there of being on the futures side, there is also, I would say, generally speaking, the price is higher on the future side to do it to do a prop challenge. I don't know if that's your experience, but when I look across at the CFD / Forex prop trading companies, the challenges are relatively cheaper and arguably there's more leverage. I would question that you need any more leverage. There's plenty of leverage anyway. Most traders, and we can come to talk about this, one of the biggest faults that I see with traders is they just trade too big size. They're over leveraged on the accounts that they're trading. The leverage they have available is enough on the future side. Do they need more leverage that's attainable on the CFD side? So I think there's an attraction on the CFD side. It's sometimes cheaper, but that's cheaper because there are extra costs involved for the prop companies on the future side. And there's also, I think, an attraction of more leverage, but my argument would be you don't need that leverage. And then ultimately, whether you're trading S&P on the CFD or S&P on the actual futures market, it's the same underlying asset, right? They're basically derivatives of the same underlying asset. The S&P 500, the largest 500, an index of the largest 500 stocks in the US. So they're all going up and down with the actual underlying index, the actual SPX. And one of them's a CFD on it, which is like a retail future, and the other one is the actual official future. And so they'll go up, and if you can make money on one, you'll make money on the other. There are some things around position sizing, the different forms of that, the contract size, and so around stock placement probably, but ultimately if your strategy works on one, it will work on the other, and there are just some small nuances. And I think the other one thing I will throw in is some people think, it's I can't trade currencies, I can't trade Forex in the futures world, where there are futures. There are currency futures. You can trade currency futures. It's a little bit more, again, depending whether it's a base or term currency. So, for example, dollar yen is quoted the other way around. So the number is different. But once you get your head around that, it all moves the same effectively. So they're based on the same underlying instruments.
Pretty cool stuff. That was a good answer for sure. That covers a lot for sure for people. What have you seen so far to be the rate of people who take your evaluations versus those who pass it? Is it a high percentage who are able to pass it, or is it pretty low in your opinion?
I think it's remarkably high. It's remarkably high. And I could talk a little about that. And I know because some of our competitors on the futures side do publish those stats. We publish those stats as well. So we have them on our site. We find it's about 30% past the evaluations. That doesn't mean, and then I'm going to just drop Top Step in there as an example, and their numbers are very similar to ours. So I think that's a kind of cross-industry number. And obviously a lot of the evaluations are fairly similar, right? Fairly similar targets, fairly similar drawdowns. Rules are kind of slightly different, but I'm thinking that's kind of around the number, somewhere between 20 up to 35%, which is high. That's high, really. I think part of that being high is because most people, when they get to the prop firm stage, and if you go to a CFD broker's site, it will tell you usually somewhere between 65 and 80% of people, they have to disclaim that, right? That 65 to 80% of people lose money trading CFDs, right? And I'm not saying CFD prop, I'm saying just CFD straight up with a broker. And I think that's for a couple of reasons. One, I think, is that when it comes to the prop firm side with the rules, most people that come into the prop firm side have more experience, right? You don't come to trading up with a prop firm as a beginner newbie, right? Most people have already gone and opened up their own accounts, their own brokerage accounts. They've maybe got burned, or they've been on demo accounts, or they've had some education. Nearly every one of our traders that I speak to, I would say upwards of 95%, anyone we have contact with knows what they're doing around the market. They have a strategy, they have an understanding of risk management. Most of them still struggle, as nearly every trader does, with the emotional side of the business and of trading. But they have a good idea. So I think that naturally puts the percentage up. When people arrive at a prop firm, they're not fresh off the boat, as it were. They're like 1 or 2 years into their trading journey, maybe, or at least 3 to 6 months into their trading journey. So I think that pushes the numbers up. I think there is something as well around people being able to pass on a prop challenge a little easier because it's on a shorter time frame, right? So currently we have our time frame is 10 days, and we're one of the longer in the industry of a minimum trading days of 10 days, certainly on the futures side. We're actually, by the time this probably goes out, we would have reduced that to 7. We're about to, it's kind of an exclusive for you, but it's not, because I think the time this goes out, it won't be an exclusive anymore. But yeah, we're about to reduce from 10 to 7. So I think that makes it a little easier as well. So that naturally, to be able to make money over 10 days doesn't mean you can make money on if you were in a brokerage account over the long run, right? So you might still lose money in the long run. So I think that makes the statistics higher as well. So you've got the professional side, the fact that it's a shorter time frame. And I think the other thing to state is that I think there's kind of a little less pressure, right? Because people are paying their, whatever it is, right? Their $100, $200, $500, whatever it might be, to pay to have a go. It's like an option, right? So you've only got limited risk at that point, and so then people, I think, that takes a little bit of that emotional pressure off. Also, I think what it means is people to take a little bit more risk than they normally would. If it was their own money, if it was in a real live brokerage account, they'd be taking less risk. They'd be a little bit more careful, and sometimes by being like too careful, then they end up chasing and it doesn't work in their favor. Where I think they're a little bit more relaxed, they take a little bit more risk, and then because of the short time period, they hit the targets quicker. So I think that sort of tells us why those stats are particularly surprisingly high on the number who pass. Now, I will say, and I don't know whether a huge amount of my fellow COOs, CEOs of prop trading companies will say this, the numbers then that then go on into a funded account and actually make successful withdrawals is kind of surprisingly much, much lower, because we see two kind of things happen, I think. One, there's an excitement that means that people move away from their trading strategy, and so they become less diligent and they lose those funded accounts quite quickly. You see this natural drop off. And there's been many studies done on the institutional market as well, when people actually go into professional prop trading companies and they're initially on demo, and then they move across from a demo simulation into live markets, and there's a deterioration in performance. So that's kind of one thing that's quite natural. I think the other thing that we see, and this is just me being very honest, is that people change their strategy, intentionally change their strategy, because what they do is they do one strategy to pass, and then they'll do another strategy to try and make quick money in the market. So the terms I would use is like a YOLO trade or a swing for the fence trade, right? So, and that may work 1 or 2 times, and you may get good results and pull out 5-figure sums, right? But is that a sustainable, we've been around long enough, right, to know that that's not sustainable. And most of the time you see the traders end up giving that money back eventually. They'll lose those. So I think those are the two reasons that we see this relatively high success rate on passing evaluations, but then a real deterioration of that actually translating into sustainable profits for traders once they're into the funded environment.
That you've covered a lot, and 30% is definitely high for these fund accounts for sure. But I mean, you've covered why they fail, why they don't pass, the big mistakes they make. Tell me about the guys who pass a challenge and then go on to be funded for a long time. What do they do differently?
They're true to themselves, I think. They're true to their strategy. Nothing makes me happier than when a trader comes to us and we put them into the live environment and they request a daily or a weekly stop, yeah, because it shows they're serious about risk management. We don't force that obviously onto the traders, but we offer it, and the large percent don't take that. And what I do see is those that do impose that restriction on themselves hang around for longer. They have more regular payouts. They might have more steady payouts. And also what I see is, they're kind of going back to the point I kind of made earlier, is the opposite to that deliberate, what I would see as a deliberate changing strategy. They keep the same strategy, right? They're true. If it works, why change it and swing for the fence? just carry on and be in there for the long run, for the long duration. But that's difficult, and I understand why it's difficult. People are. It's not even greed, I don't think. It's more just like, I've got this opportunity, I'm excited, I'm going to go for it. I'm going to take the opportunity and get what I can now, because I may not have this opportunity again. But cliches are cliches for a reason, right? It's a marathon, not a sprint. If you want to have a lifestyle changing event, and you want this to be your future as a successful trader, then you have to stick to long-term goals, and you have to stick to a strategy that works over time, and not just, professional traders don't swing for the fence. Hedge funds are not just like, well, this might happen. There's a black swan event potentially out there. Let's go for that. That's not how investing is done. That's not how hedge funds work. And if you try to do that, I've been in the institutional world for 20 plus years, and if you try to do that in the institutional world, you'd be out of a job very, 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 very quickly. So but when it's your own money and there's potential for life-changing money quickly, I can understand why people do it. My advice would be, don't do it. And it also comes back to that, what I kind of hinted at earlier on about over leveraging, right? On our $250,000 account, you can trade 25 minis. That's a huge amount of size. And we have people going to that max on something like the NASDAQ, which is hugely volatile, right? And you don't need to have 25 minis on the NASDAQ. And then I hear people from the CFD world, and they come over and they say, oh, can I only trade 25 minutes? So that's not very much leverage. Well, I'll tell you what, that's enough leverage, right? That is definitely enough leverage and what you need to be successful and make money as an individual. So over trading and not being true to your strategy would be the two things that the unsuccessful people do. So to be successful, keep within your position limits, keep it small, on the smaller side, build slowly, and then stay true to the strategy.
Where can people find you more about what you do and the platforms you have, and where can they kind of get a challenge?
Yeah, so we are tradeday.com. It's as simple as that. Come to tradeday.com. There's plenty of information there on the site about everything we do. There's also then a very extensive FAQ section that goes into all the details. We try to keep it as simple as possible, but obviously that's kind of tricky because there are a lot of nuances to all of this. There is quite a bit of educational stuff in there as well. Plus, then if you want to, you can sign up you don't have to sign up and pay. You can sign up for a 14-day free trial. And with that 14-day free trial, you get complete access to both the trading platform, so you can go and practice, but then also you get access to all of our resources. So there's loads of educational resources on there about futures, about our broker, about setting up your platform, about technical analysis, macro fundamentals. We have daily research reports there that go up from on the technical analysis side that are written by myself. We have weekly macro, we have daily news updates, and we have a 24-hour school service as well that we provide. So there's lots of stuff in there, and also the psychological, emotional side of trading as well. So you can sign all up for all of that on a 14-day free trial. Just go to tradeday.com. Any questions, support@tradeday.com, and that's the way to find us. And we are seeing, over the last 6 to 9 months, a slow exodus of users across from that CFD world. As I think as there's just concerns about, am I going to get my money back? How safe is my money? And there is another way to do this. And yes, it might be a little more expensive. It might be a little trickier to get your head around. If you're a successful trader, there's no reason you can't understand futures. If you're smart enough to trade, you can get your head around futures. So come across, take a look at tradeday.com, and we'll be happy to help you in any way you can.
Awesome. We don't talk a lot about future platforms here on the channel, but I know you're one of the ones that I really respect and that you do things right for sure. So definitely we send people your way all the time. So I appreciate that. Thank you, Steve, for your time. And hopefully people get some value out of this, and they can reach out to you and connect with you after. I appreciate it.
Yeah, thank you, Etienne. Thank you for saying that as well. We appreciate that.